Yes, sir.
Okay, so we'll start from where we left last time. You can always watch the recording now, which is available on the YouTube. So basically, this is the eligibility requirement for an initial public offer. So whenever a company goes for an IPO, so what are the requirements? So we have covered some of them. So today we are going to cover a little bit more. An issuer shall be eligible to make an initial public offer only okay, eligibility requirement, okay, if the net assets, if the net, it has net tangible assets of at least 3 crore rupees, okay, so it must have a net tangible assets of at least 3 crore rupees. Now, what are net tangible assets? Basically, you can see on a right screen, right hand side of the screen, which is net tangible assets is equal to total assets minus intangible assets. So intangible assets like copyright and others minus the liabilities. So these are the tangible assets of the company. So that means, it will be generally plant, machinery, equipment, stock, furniture, which is given on the bottom of the slide. So it has a net tangible assets of at least 3 crore rupees. So a company who doesn't have any net tangible assets, less than 3 crores, then they cannot come with a public issue as per this, eligibility requirement. So it has to be calculated on a restated and consolidated basis, okay, in each of the preceding 3 full years. Fine. That means the last 12 months. So that means they should have net tangible assets of at least 3 crore rupees every year, okay, for the last 3 years, of which not more than 50% are held in monetary assets. So we'll discuss what are monetary assets. So all these net tangible assets, not more than 50% should be held in monetary assets. Now, monetary assets can be like cash, bank balance. Okay, so we'll talk about that. So, provided now, what are monetary assets? Like, receivables, see on the right hand side of the screen, bank deposits, other receivables, cash, investment in debt capital. Suppose you have taken some bonds or invested some money in debt capital. So these are some of the examples. Provided that if more than 50% of the net tangible assets are held in monetary assets, the issuer has utilized or made firm commitments to utilize such excess monetary assets in its business or project. So suppose at the time of issuing, coming up with a public issue or an IPO, if the company has more than 50% in monetary assets, that means it has cash and bank balance or money receivable from their customers. So if it is more than 50%, then they have to make firm commitments that they're going to utilize these monetary assets. What they're going to do, they're going to buy assets, fixed assets, invest that money in plant, machinery, everything. So let's talk about example of monetary assets. Now I'm just giving you this thing that there's a company called ABC, and the numbers are in crores. So they have last 3 years numbers are given on the screen. So they have bank deposits 1.5 crores in 2021. Like this, they have bank balance of 2 crore 25 lakhs in 2022, and in 2023 they have a bank deposits of 2.9 crores. So trade receivables numbers are given on the screen. Cash balance is there. Short-term investments are there. So overall, so every year they're having, first year they're having 4.5 crores in 2021, in 2022, 6.5 crores, and in 2023, 7.5 crores. Now tell me, is this company meeting the requirement of the, as far as the, net tangible assets are, sorry, as far as the monetary assets are concerned? Okay, so still the question is, to be answered will be after we see the other numbers. Okay. So net tangible assets of the company of ABC Limited, which is given, at the bottom. So the monetary assets have been picked up from there. 4.5 crore, 6.5 and 7.5 is coming from here. Okay. So they have fixed assets, 25 crores in 2021, in 2022, 30 crores, and in 2023, 32 crores. So similarly, intangible assets, they have 12 crores, 14 crores, and 15 crores in the last 3 years. Monetary assets, which are picked up from the last sheet, total assets 41 crores in 2021, 50 crores in 2022, and in 23 they have 54 crores. Okay, total assets. So if we and the tangible asset would be 41 minus the intangible asset will be 29.5 crores in 2021. Likewise, in 2022, they have 36 crores. And in 2023, they have 39.5 crores. So these are tangible assets, which means the total assets minus the monetary assets, which are given on your screen. Now, if you minus the liabilities, which are given there, in the first year, 2021, they have 13.5 crores liabilities. So which means the net tangible asset would be 16 crores. Similarly, for 2022, the net tangible asset, which is tangible assets minus the liabilities, is 24.5 crores. And in 2023, the tangible assets were 39.5 crores minus the liabilities, 15 crores. So they have net tangible assets of 24.5 crores. So monetary assets would be basically 28% in the first year, okay, which is basically your monetary assets divided by the net tangible assets. So 4.5 crores divided by 16 crores, it comes to 28%. So similarly, in 2022, they have 27% monetary assets, and in 2023, it goes up to 31%. Now, tell me, Shubhangani or Yash, whosoever, is this company meeting the criteria of an IPO? How much should be in the monetary assets first of all, and what should be the total net tangible assets every year? Anyone?
So it's eligible because it has more than 3 crores.
Yeah, more than 3 crores. Who is speaking?
Yashwardhan.
Yes, yeah, very good. So it has more than 3 crores. So first criteria, it has more than first crores, 3 crores every year. And second, the monetary assets should not be more than how much percentage? 50%. Okay. So, look at this, that not more than 50% should be held in monetary assets. Look at the bottom line. Okay. So here, if they have more than 50%, then they should make some arrangement. They're going to spend and buy fixed assets. So here, if you look at in all the 3 years, are they meeting the monetary asset criteria, Yash?
Yeah, sir.
Okay. So, and what is the requirement?
That it should be below 50%.
Yeah, below 50%. Okay. So that means it is meeting the criteria. Okay. Now, Yash, can you read this?
Oh, yeah. So provided further that the limit of 50% on monetary assets shall not be applicable in case the IPO offer is made entirely through an offer for sale.
So if the IPO is where there is an offer for sale also, of course the company can issue fresh issues of shares, as well as an existing shareholders can dilute their holding and sell them those shares in the market through an IPO. So this limit of more than 50% is not applicable for if there is a public offer is made entirely through an offer for sale. For example, like LIC offer which came, okay, or IRCTC offer which came in past. So they were all offer for sale where the central government were offering their own shares to the public. So in that case, this monetary more than 50% of the monetary asset is not applicable. Okay. So I'll just show you an Excel sheet, okay, where I have put these numbers. Um, okay, just have a look here. This is net tangible assets. Okay, I can just change the years. It is 2021 now, which I mentioned here. And sorry, 2021, 2022, 2023. Okay, and there also I can change. So we're talking about, this was the last year, when I made this. Now we are in 2003, so somebody's coming an IPO this year. Okay, so I'll just save it. Now the fixed assets are given, okay, and the monetary assets which you saw on your screen were 28%. Okay, then in bank deposits and everything is given monetary assets which I have picked up. Okay, so this has been picked up from there. So this has basically coming from here. So I've linked here. Okay, now Suppose I make, monetary assets, I make monetary assets as, 50 crores here. Now tell me, is this company meeting the criteria? Is this company can go for an IPO? Is it meeting the criteria? What are the monetary asset percentage now? Look at the bottom line. Yes, Zubain, are you there?
So now it will be 76%.
Yeah, it is 76%. So that means the monetary assets are more. So it has, the bank balance has gone up. Okay, so the last bank deposits is more. So which has actually pushed up the monetary asset to 76%. So this company cannot. So they have to make firm commitments. Okay, so in this case, if a company has more than 50% in monetary assets, so they have to make a commitment and they have to tell before they issue an IPO. So they have to say that they are going to spend this money and they're going to invest the money before the issue is opened or for the public. Okay, so have you got it? Any questions here? Have you understood? So it's getting recorded. Fine. So let me just go back here. Okay. So there are a lot of students now. Rishi, have you followed? Shubhangini, are you all there?
Yes, sir.
Now you
Yes,
tell me
sir.
what is the first condition? How many? What should be the amount of net tangible a company should possess in the last preceding three
So
years?
three,
3 crores. Okay. And how much should be the monetary assets? Uh, I mean, what are
so below
monetary assets?
50%.
50%. It should be below 50%. And just give me some
Below
example.
50%.
Give me some examples of monetary assets.
Monetary asset examples.
Yeah, some example. What are monetary assets? Monetary assets, which can be converted into cash immediately. Company can, try to meet the criteria by
Uh,
putting a lot of money in the bank. So that is harm. So what should it include basically?
so I think accounts receivables,
Yeah,
which are yet to receive,
yeah,
maybe investment accounts,
yeah. Or bank balance, okay? The bank deposits, fixed
bank
deposits.
balance.
Yeah. So, this is basically if a company wants to, come up with a public issue and, their net tangible assets are below, 3 crores. It is 3 crores now. Okay. So, what was the criteria? 3 crores, you know? Let me just check. So it should be 3 crores. Okay. So suppose a company doesn't have, net tangible assets of 3 crores. So it may, the promoters will bring a lot of cash and put the money in a bank to meet out the requirement. In that case, the monetary assets will, go up more than 50%. Okay. So in that case, the company will not be allowed to go for an IPO if the monetary assets are more than 50%. So sometime the company may not have sufficient, net tangible assets. So they may pump in some kind of a cash. The promoters can bring, some bank balance, and they can improve the bank balance and say that they are meeting the criteria. But in that case, the percentage of monetary assets will exceed 50%, and they have to make a firm commitment to the public. Before they come up with an issue. So this is basically to see that the company is, has a certain amount of assets. And what are net? What is? How do we? What is a formula for net tangible asset? Yash or anyone? Please participate. So what is, net tangible assets? If I say net tangible assets, so what does it mean? Okay. So what is the formula for net tangible assets? Or what is, how do
So,
we,
so you
yeah, yeah.
so if you take total assets minus intangible assets and minus liability.
Yeah. So that's on your screen. So the total assets minus intangible assets. Give me an example of intangible asset. Anyone?
So intangible, goodwill or
Copyright,
yeah, goodwill.
goodwill. Yeah, very good. So, so this is the basically the first criteria. Okay, fine. Now this criteria is not applicable in case where there is an offer for sale, where existing shareholder is offering its own shares to the public so that he gets money. So in that case, this 50% criteria will not be applicable when for. Give an example for offer for sale, which I gave. The two companies which I mentioned, no, where the government came with the public issue. So what are those, companies where there was an offer for sale, like IRCTC or LIC, where the public, where the company was, where the government was making a disinvestment in their own shares. Okay, so they were offloading their shares to the public. So that is not applicable. Okay, fine. So now, Shubhangini, can you read
Yes, sir.
from the
Eligibility
top?
requirements for an initial public offer.
Yeah.
It has an average operating profit of at least 15 crores rupees calculated on a restated and consolidated basis during the preceding 3 years of 12 months each, with operating profit in each of these preceding 3 years.
So that means the second criteria, the first criteria was regarding the net tangible assets, where the company should have, on an average, a net tangible assets of 3 crores. Okay. The second is that it should be a profitable company. Okay. At least 15 crores of profit should be there. Okay, during the preceding 3 years. Okay, so it has a average. So here the number is average. So here the average operating profit of at least 15 crores uh, is there. Okay, with operating profit in each of these preceding 3 years. So that means the average should be more than 15 crores, and in each year the company should be profitable. Okay, now on your right hand screen you can find that the operating profit of the company is basically the revenue minus all the cost, okay, including depreciation. So if the company is still making a profit, so that means the company making a profit by selling their goods and services to the customers. Okay, so that is called the operating margin. So I'll give you an example here. So here basically, this is an income statement which has the revenue for 3 years, and the average is also calculated. So company has an revenue of 1680 crores in 2021, and then it goes to 2000 in the 2023, and average is 1827 crores. Okay, so cost of goods sold, gross profit, expenses. So the second line is operating expenses. We add them all, then operating profit and the average. The last line, just focus on the last line. So is the company having making operating profit every year, Shubhangini?
No, sir.
No. Is the company making operating profit in every year, 2021, 22, 23? Yes or no?
So it's making operating profit in every year, but it has a decreasing rate, like 22, then 10, and then 12.
That is okay. But what is the average profit they have made? Last this thing column.
50.
15. So that meets the criteria, isn't it? Even if you are,
Yes.
making the profits going up and down, but if your average profit for the last 3 years is 15 crores, you can go for an IPO. Okay, fine. So that is what it's saying. So now you can just see here also. I have just put in an Excel sheet. So which was operating profit. Okay, so this is the operating profit. So you can always make some changes and find out. So here the average is coming 15 crores. Okay, fine. So suppose the cost of goods sold is say 1900 crores. Okay, so what happens here? So is this company entitled for going for an IPO now, Shivangani? Look at the operating profit,
No, sir.
because the operating profit in the last year is negative and average is coming minus 35 crores. So this company cannot go for operating profit. Okay, fine. I think I've shared this, but I'll share it again on a Google Drive so that you can see there, or Blackboard. Okay, fine. So that you can always understand. Okay, so fine. Now read this criteria, this thing, Shubhangini. Are you there? So I think there's some issue there. Yash, can you read?
It has a net worth of at least 1 crore rupees in each of the preceding 3 full years of 12 months each, calculated on a restated and consolidated basis.
Okay, so it should have net worth. Okay, and what is net worth? Total assets minus total liabilities of the company. So it has net worth of at least 1 crore rupees in each of the 3 preceding years. Okay, that means each of the 3 preceding, it's not average. So every year it should have at least a net worth of 1 crore every year. Okay. Now, net worth is basically the assets minus liabilities. Okay. And then if you look at this example of the same company, ABC, so it has, assets, fixed assets, it has current assets, total assets, it has liabilities, some borrowings, and the net worth at the bottom. So that means your assets, total assets minus your total liabilities. So it comes to 35 crores in the first year. Second year, it is coming to 25 crores, and in the third year it is coming to 33 crores. Now tell me, Yash, is it it is meeting the criteria of an IPO?
Yeah, sir, it's more than 1 crore.
Yeah, it should be, one more than 1 crore in each of the three, years, preceding 3 years, and so it's meeting. So that means, this company is meeting. So again, I have made an Excel sheet here, so you can, always, look at this. Fine. So it has an asset. Suppose I change it to this 250 crores. Okay. Sorry, I make it to 80 crores here. So tell me that, the company is meeting the criteria here. Yes.
No, sir,
It
because now
has,
in
yeah,
because each year has to have 1 crore.
1 crore. So in the first year, it is having minus 35 crores. Okay, fine. So this company is not meeting the criteria. And if you just change this number, so here it is meeting. Okay, fine. So let's go back. So we have followed this. Okay. So now just read. Shubhangini, are you back?
Yes, yes, sir. Sorry, my net was not working, sir. I had to
Okay,
continue.
okay. Now read this.
Yes, sir. Eligibility requirements for an initial public offer. If it has changed its name within the last 1 year, at least 50% of the revenue calculated on a restated and consolidated basis for the preceding one full year has been earned by it from the activity indicated by its new name.
Now, sometime the company can change its name, okay? So if the company has changed its name, then that means most likely the business might have also changed, okay? Fine. For example, let's take an example here. So the old name of the company was ABC Car Limited, okay? Look at the second, this thing here, okay? So name of the company Revenue, okay? So now the new name of the company is ABC Scooters, so which means the company is, changed their business, okay? So now it says that, if you look at the revenue of the company, it was 100 crores with the old name, and in 2023, and with the new name, its turnover was 150 crores. So which account for 60% of its revenue from the new name. Okay, so total revenue was 250 crores, which is the 100% of the revenue. 60% was coming from the new name. Now, Shubhangini, just read this and tell me whether this company is meeting the criteria of an IPO.
Yes, sir.
Is it
If it
meeting?
has changed its name within the last 1 year, at least 50% of the revenue calculated on a restated and consolidated basis for the preceding one full year has been earned by it from the activity indicates by its new name.
So it has to earn more than 50% of the revenue on with the new name. So how much it is earning with the new name?
Yes, sir. 60%.
So 60%. Is it meeting the criteria?
Yes, sir.
Okay, very. So let's move on to some general conditions. Okay. Okay, just read this.
General conditions. An issuer making an initial public offer shall ensure that it has made an application to one or more stock exchanges to seek an in-principle approval for listing of its specified securities on such stock exchanges and has chosen one of them as the designated stock exchange.
So that means, first of all, it has to make an application, okay, to either one or more of the stock exchanges. Now, in India, we have two stock exchanges, National Stock Exchange and Bombay Stock Exchange. So it can either make, either of it or both of it. And then it has to, if it has chosen both of them, then it has to make one exchange as its designated stock exchange. Okay. So it has made an application, one or more stock exchanges to seek an in-principle approval for listing of its specified securities. So that means where it is going to list its shares. Okay, so it has to choose that stock exchange and then choose one as designated stock exchange. Okay, then read further.
B. It has entered into an agreement with a depository for dematerialization of the specified securities already issued and proposed to be issued.
Now, nowadays all the companies, when we buy shares, we have a demat account. Okay. So, they are depositories like, NSDL or CSDL. So these are the two, national depositories. So they are opening, demat account for everyone. So it has entered into an agreement with the depository for dematerialization of the specified securities already issued and proposed to be issued. Now, of course, since nowadays all the securities are already dematerialized, so the new proposed issue has to be also, they have to seek approval and make an agreement with the depository for dematerializing the proposed issue also. Is that okay? Okay, next please.
It okay. All its specified securities held by the promoters are in dematerialized form prior to filing of the offer document.
So even the promoters who are holding shares, they should not hold the shares in a script form or a paper form. So their shares should also be dematerialized. Now, of course, all the companies and the promoters, they hold shares in demat form. But, in the beginning, many shareholders, they were not, filed to the depository for dematerializing. So now, it is mandatory for, not mandatory, but all people are required to, get the shares demat. So even the promoters, this rule is applicable to promoters that their share should be in demat form before they file an offer document, which is the prospectus, to the public for raising the money. Okay. And last,
All its existing partly paid up equity shares have either been fully paid up or has been forfeited.
so, that's one general condition that all its existing partly paid up equity shares have been fully paid up. So, if the company has to receive some money from the shareholders, okay, then it can be a call money or whatever. So, if they have to still, take some money from the shareholders, they should, take that money from the shareholders before they go for a public issue. And if they don't take, then their share should be forfeited. Okay, so that's a criteria that all existing partly paid up equity shares have been either fully paid up or have been forfeited. So this is one of the conditions. Okay, now this one.
It has made firm arrangements of finance through verifiable means towards 75% of the stated means of finance for a specific project proposed to be funded from the issue proceeds, excluding the amount to be raised through the proposed public issue or through existing identifiable internal accruals.
Okay, so now this is a little complex one. So let me explain that, let's take an example. Suppose the company is coming with a public issue, an IPO, to meet its new project. Okay, fine. So the project cost is 2000 crores and they are going to raise this money 1000 crores from the proposed public issue. Okay, whether it's the IPO or FPO, whatever it may be, internal accruals. So that means they have some money in their reserves and surpluses. That means the past profits, 200 crores, and they are going to take loans of 800 crores. Okay, so altogether it comes to 2000 crores. Now they have to make a firm arrangement from a verifiable means, that is 75% of 800 crores which they are going to take loans. They have to get a tie-up with a bank or with a lender, and the lender should issue a letter to the company that they are going to lend this money, either whole of it or at least 75% of it. So, sometimes companies can go for a issue and they have not made any arrangements for loans. And what happens is that, sometimes the lenders can, shy away from making, paying loans to the company. So, which means that, company is not able to raise the entire amount. So, to make sure that, company, if it has some money to be picked up from loans, from financial institutions, banks, so those, they should, get the firm arrangement, a letter, which they should file with the SEBI that they have a complete, backing of their lenders, that they are going to lend at least 75% of the money which they have stated, from the means of finance. So now if you read that, it has made firm arrangement of finance through verifiable means. Okay, so that means they have a letter, a confirming letter from the bank that at least 75% of the stated means of finance for specific project to be funded from the issue proceeds, excluding the amount to be raised through proposed public issue or through existing identifiable, internal accruals. So which means that, excluding the 1,000 crores, which is the public issue, and 200 crores, which is the internal accruals. So the 800 crores ka 75% they have to get a firm arrangement. So which means that to be funded from issue proceeds, excluding the amount to be raised through proposed public issue, which is 1,000 crores, or through existing identifiable internal accruals, which is 200 crores. So barring this, so the only the loan portion, out of that 75%, they should have a letter, a confirmed letter from the bank or from the institution who is funding them, okay, that they are going to get 75% from that particular bank. Is that, have you followed, Shubhangini? Is it clear? Or, anybody who wants to have further information, if he has not followed. Shubhangini, have you understood?
So I didn't understand the part when you talk about the public issue difference, like 75% of the total. I didn't understand that part.
75% not of the total means of finance, 75 of the stated means of finance for a specific project from the issue proceed, excluding the public issue, excluding the internal accruals. So that means that the means of finance are going to be 800 crores from loans. So he's talking about that. Now, 75% of this is 600 crores. Okay, so that means this, any company, or if suppose this company going for a public issue, so they should get a letter from the bankers that the bankers are going to give 600 crores to them. They have approved their application for the loan, and they are going to give 600 crores. If the company has a letter for 600 crores, then they have a firm arrangement for at least 75% of the money which they are going to raise for meeting this project, and the 800, the money would be only the loans, not the public issue as well as the internal accruals. Okay, it should not be 75% of the entire 2,000 crores. It should be only 75% of the 800 crores. Have you followed now?
Yes, sir. Now I understood.
Okay. So now, okay. So this is the same thing. Okay. Now come again. Next one.
The amount for general corporate purposes as mentioned in objects of the issue in the draft offer document and the offer document shall not exceed 25% of the amount being raised by the issuer.
So the amount of general corporate purposes as mentioned in the objects of the issue in the draft offer, the amount of general corporate purpose as mentioned in the objects of the issue in the draft offer document, and offer document shall not exceed 25% of the amount being raised by the issuer. Now, there is, when the company issues, they issue a draft offer document before, it becomes a prospectus, and then it becomes, offer document when it becomes a complete prospectus, when the SEBI gives nod. So, let's take through an example. Suppose, this is the project which is involving 2,000 crores, and they have given, the breakup where they're going to spend this money. Plant and machinery, 1,000 crores, land, 500 crores, general corporate purpose. Now, company, while giving this breakup where the money is going to spend, so they can keep some money for general corporate purposes, which they have not identified as yet, okay, and which may contain a lot of, other spendings of the company. So that should not be more than 25%. Now, if you look at this case, here they are going to spend 2,000 crores, and out of that, the general corporate purpose is only 25%. So let's go back and see. The amount for general corporate purpose, as mentioned, the objects of the issue in draft offer document and the offer document shall not exceed 25% of the amount being raised by the issuer. So in this case, the company is going to raise 2,000 crores through an IPO or an FPO, and they have given a breakup from where they are going to spend that money. Okay, they have given that they are going to spend 1,000 crores on plant and machinery, they are going to spend 500 crores on land, and they have given 500 crores which they are going to spend for some corporate purpose. So now if you look at the percentage of how much they mentioned for the general corporate purpose, it comes to 25%. Okay, had it been more than 25%, then they have to give a specific purpose for that. They can't keep it 25% for more than 25% for the general corporate purpose. Okay, so now look at this second example. Plant and machinery, 1,000 crores, land 300 crores, investment purpose. Now, they have given here investment purpose. So here also they have not specified. They said they're going to invest the money. And general corporate purpose, 400 crores. Okay. So now there is an amendment, new amendment, general corporate purpose and unidentifiable investment should not be more than 35%. So even if they give this kind of a breakup, then the first was at 25%, but if they mention that there has to be some, some investment purpose they have given, and the combined investment purpose and general corporate purpose should not be more than 35%. Now, if you look at this, then the company is meeting the purpose. That investment purpose is 15% and general corporate purpose is 20%. So if even this is there, it's fine. So have you followed this, Shubhamini? Or all, please, everyone.
Yes, sir.
Okay. So then the most important one for the day. Okay, can you read this from the
I'm
top?
sure not satisfying
No, from the top.
eligibility requirements for an initial public offer, alternate eligibility.
Okay, hold on.
An issuer not
Hold on,
satisfying.
hold on, hold on. So eligibility requirement for an initial public offer, alternate eligibility. Now, we have understood a lot of, conditions which were regarding the net worth, regarding the operating profits, regarding the net tangible assets, and so on. So this is an alternate eligibility. So if the company is not meeting the criterias which we have just discussed, which are financial criterias, then can a company go for an IPO? Okay, now in past companies like Zomato, Paytm, they have come with an IPO, but they were not meeting any of the financial criterias which we had just discussed. So just read this now.
An issuer not satisfying the stipulated conditions shall be eligible to make an initial public offer only if the issue is made through the book building process and the issuer undertakes to allot at least 75% of the net offer to qualified institutional buyers and to refund the full subscription money if it fails to do so.
Okay, so please listen carefully. So, I would like that everybody should participate when I ask questions, particularly this is the most important part of our understanding of IPO process and IPO. The issuer not satisfying the stipulated conditions shall be eligible to make an initial public offer. So he can still go for an IPO if the issue is made through, there are two conditions, if the issuer is made through book building process. So they have to follow a book building process, and we're going to understand what that means, and undertakes to allot at least 75% of the net offer to qualified institutional buyers and refund the full subscription money if it fails to do so. So that means that two things, book building and qualified institutional buyers. So if the company is not meeting the criteria, the financial criteria which we just discussed in our slides before, so they have to offer, the first thing, they have to offer 75% to the qualified institutional buyers. So that means the people who are called qualified institutional buyers. So let's talk about who they are. Okay. So qualified institutional buyers. So that means these are the big buyers. Okay. Fine. When, if 75% money has to be offered to them. Okay. So if, big players who have good financial muscle, who have understanding of the company, if they can subscribe 75%, then the government or the SEBI has no, they allow such kind of offers. Okay, fine, even if the company is not meeting the financial criteria. Now just read this.
Qualified institutional buyer. Qualified institutional buyers are those institutional investors who are generally perceived to possess expertise and the financial muscle to evaluate and invest in the capital markets.
So basically these are the people who have expertise and financial muscle, okay, so that they can evaluate and invest in those companies. Even the companies don't have net worth, don't have operating profit in past, or they don't have the net tangible assets or whatever. So they can be allowed to go ahead and make a public offer if, the QIBs, which we call them in short, if they have invested 75% at least in these companies. Okay, let's talk about who are QIBs. So there are 13 QIBs in India. They are required to be registered with SEBI. Okay, the first one is mutual fund. So we all know who are the mutual fund. If mutual funds are offering money to the to the company, then they can. These are called QIBs. Okay. Then the venture capital fund. Okay. Now some other terms, if you don't know, I will explain them separately. Okay. So I'm just going to mention them. Who are they? Alternate investment funds. So there is some category called you all know what are venture capital funds, okay? But in great detail we'll come and understand later in my lectures. Alternate investment funds. Now these are funds which are big ticket size investments where only people with a certain amount of net worth they can only qualify to invest in that. Maybe the figure is around 1 crore. I don't remember at the moment. What is the current figure? So all the companies or all the investors, HNIs who participate in these funds, the minimum ticket size has to be 1 crore. So these are called alternate investment funds. Then foreign venture capital investors. Okay, so these are QIBs, foreign portfolio investors. So they are eligible and called QIBs. Okay, public financial institutions. Okay, then commercial banks, scheduled commercial banks. So if they do it, they are qualified as QIBs. Okay, so these are how much? 7. So multilateral and bilateral development financial institutions, okay, I mean, which are like World Bank and others. Then state industrial development corporations, the industrial development corporations owned by states. Insurance companies, like LIC, fine, or any other private insurance company. Then provident fund with a minimum corpus of 25 crores. So there is a provident fund trust which is generally floated by the companies in India and abroad. If they have 25 crore rupees of corpus, that means that they have 25 crores of money with them. So they are allowed. Pension funds with a minimum corpus of 25 crores. Okay, fine. Public financial institutions. There are a lot of pension funds that is sitting abroad. They invest money in India, so they are allowed and they are qualified as QIBs, but provided their minimum corpus is more than 25 crores. Public financial institutions, scheduled commercial banks. Okay, thank you. Okay. So, is that clear? Any questions here? So these are QIBs, okay? Fine. Now we understand who are the QIBs. There are 13 QIBs, okay? List they have to be, they have been, they are registered with the SEBI and they are allowed to participate in an IPO or an FPO. And in case if the company is not meeting the financial criteria, then minimum or at least 75% of the money should be offered to qualified institutional buyers. And the second was book building. Okay, now tell me, can you name some of the qualified institutional buyers, and can you describe them what they are? Any one of you? Jumabini?
So I'm not sure. Maybe LIC.
Yeah, LIC. Yeah, absolutely. You picked up right. So LIC was one. Okay, then pension funds. So now these are the what are, I mean, what is the definition of qualified institutional buyers, or how do we define them? Who are they? Basically, they are big investors. Okay, they have big financial and they can understand and go through a process of understanding the company before they can invest. So they have financial muscle. They have an expertise in understanding the company's business. Okay, so that's why they're called QIBs. Okay, now we come to book building. Okay, have you heard about book building in past? Anyone? Okay. Swangni, can you read?
Yes, sir. Book building is a process that helps companies discover the price of their security when the shares are being offered for sale in an IPO with the help of investment bankers.
So basically, now the role of a merchant bankers come in, okay, the subject which we are studying, okay. So book building is a process that helps companies to discover the price of their security when their shares are being offered for sale in an IPO with the help of investment bankers. So it is investment bankers or the merchant bankers, they, help the companies to raise money, okay. They help the companies to discover the price of an IPO, okay, with a process which is called the book building process. Read further.
Major stock exchanges and regulators recommend it because it is the most efficient mechanism to price securities in the market.
So basically, now book building process is basically done with the help of stock exchanges and with the help of merchant bankers. Okay. So we are going to understand what is, book building process little in detail. Okay. So I'm just opening a slide where I've covered, and after that we'll have a small break after we have covered the what is book building process. So book building process. Can you read, Shubhangini?
Yes, sir. Book building is the process by which an underwriter determines the price at which the shares must be sold in an initial public offer.
Okay, so underwriters are basically the merchant bankers, or syndicate bankers. So, all the, public issues where the companies are raising money through public, they have to be underwritten. Okay, so the merchant bankers, underwrite these shares. Okay, and we'll talk about that more in detail in my coming slides. Okay, further.
The process of price discovery requires the underwriter to call for bids from various institutional investors, such as fund managers and others. However, there always exists a risk of overpricing or undervaluing the shares.
So basically here, the underwriter or the merchant banker, they have to, this is a process through which, the price discovery happens. What should be the right price for an IPO? Okay, so they call for bids from the institutional investors, okay, mainly through fund managers and others. So of course, it doesn't guarantee that the price would be the right price. Still, the price can be overpriced. Like in case of Paytm, when they came up with an issue with the help of a book building process, but then the share prices tanked thereafter. So it doesn't mean that 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 this would be the price, should be the right price or the fair price of an issue. So there is no guarantee, okay, or it can be even undervaluing those shares. So they can offer shares at a very low price. So the book building mechanism doesn't ensure that you are going to get the fair price of an issue, but it helps because the merchant bankers are going to evaluate and tell what should be the price band, okay, on the basis of the judgment. So we're going to understand that more in detail in my coming slides. Okay, okay, further.
The issuing company hires an investment bank to act as an underwriter who decides the price range of the security. The investment bank then invites large scale buyers, fund managers, and others to submit bids on the share.
Okay. Now, issuing company hires an investment bank to act as an underwriter who decides the price range of the security. Now, the merchant banker or the investment banker, they are going to decide what should be the range of the price. Okay. It should be between, say, 100 to.
I'd say the mom would definitely be very curious.
Haji?
Alex can tell you about it.
Okay. I'm hearing some voice. I mean, who's speaking? Okay. So, who decides the price range of the security? So, the merchant bankers are going to decide about the range of the price. Okay. Between what band the price should be announced to the public. So, it can be, say, for example, 100 rupees to 120 rupees, and then they can invite the bids from the from the institutions. The investment bank then invites large-scale buyers, fund managers, and others to submit their bids on the share. So, this basically process is thrown to the large scale buyers, okay, not to the retail investors, okay. Of course, in past, they were, even the retail investors, they were also, making bids. But now let's understand further. Okay, read this. Shubhangini, is there any problem?
No, sir.
Okay, because I heard some. Okay,
So
just
it
go
was
through.
not from my side. It was someone's mic was open.
It was like.
So it was not from my side. Maybe someone else's mic was open.
Okay, 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 okay. Fine. Just go ahead now.
Yes, sir. Book building process. The book is then built through the listing and evaluation of the aggregated demands for the issue from the submitted bids. The final price of the security is termed as a cutoff price.
Okay. Now, there's a lot of theory here. So I'm just skipping this theory and just coming to an example straight away. And then we can go back and understand the theory, okay? So this I'm going to explain. So this is an illustration of book building, okay? So illustration of book building and price discovery process. Bidders can bid at any price within the price band. For instance, suppose there is a company which has fixed a price band of rupees 20 to 24. So that means it says that it's going to offer the shares somewhere between 20 to 24. So it has to announce with the help of merchant bankers what is the price band. An issue size of 3,000 equity shares and receipt of 5 bids from bidders, of which one bidder has bid for 500 shares at 24 rupees per share, while another person has bid for 1,000 shares at 23. Okay, so let's look at this. Just read Shubhangini, this thing.
Yes, sir. Illustration of book building. A graphical representation of the consolidated demand and price would be made available at the bidding centers during the bidding period. The illustrated book as set forth below shows the demand for the shares of the company at various prices and is collated from bids from various investors.
Okay, now let's say that the company XYZ has received the following 5 bids and the issue size is 3,000 shares. Okay, so someone has applied for 500 shares and he has given a bid price of 24 because the bid was between 20 to 24, so you are allowed to make choose any bid price. So one person who has made an application for 500 shares and he has made a bid price of 24. Now there's another shareholder who has made 1,000 shares. He has applied for 1,000 shares and given a bid price of 23. Now you are allowed to make a bid between 20 to 24. So that's your choice. Now there's another shareholder who has applied for 1,500 shares and he has given a bid price of 22. Now there is another shareholder or investor, or not shareholder but investor, who has applied for 2,000 shares and he's given a bid price for 21. And finally, there is another investor who had applied for 2,500, okay, and he has made a bid price of 20. Okay, now you can see, there is 500,000, 1,500, 3,000, 5,000, 7,500, application for shares have been received by the company, and shares, their issue size is only 3,000. So that means they have received more than 2.5 times. So this share is 2.5 times oversubscribed. Okay, we can say that. Now, so now company XYZ wants to issue 3,000 shares through a book building process. Assume the price band is 20 to 24 and receipt of 5 bids from bidders, details of which are shown below. So 500 bid quantity, bid price 24. So cumulative 500. So that means 16.67%, which is 500 divided by 3,000. So here for 16.67% have been subscribed. Now another person has given 1,000 shares application. So he has put a 23 rupees price. So cumulative quantity would be 1,500, which makes about 50% of the total issue size up to now. Then there's a third investor who has applied for 1,500 shares and he has given a 22 rupees as a bid price. So at 3,000, so that means the cumulative quantity is 3,000, which is 100% of the shares which the company has gone for an issue. So 22 becomes the cutoff price. Okay. Now let's go to the next one. There is another person who has given for 2,000 shares application, but he has given 21 rupees. And then the cumulative size will be 5,000. So that means 166% of the subscription has been subscribed with this investor. Finally, there is another investor who made an application for 2,500 shares at 20 rupees. So cumulative quantity is 7,500. So subscription is 250%. So that means this issue of an IPO is subscribed 2.5 times than what it was originally planned for. So at a bid price of 22, if you can see at the middle of it, the company has received entire money. So now let's see. The price discovery is a function of demand at various prices. The highest price at which the issuer is able to issue the desired quantum of share is the price at which the book cuts off, that is 22 in the above example. So here the book has cut off at 22 when the company is able to generate all what it needs. So 22 becomes the price of this an IPO. Okay, so at this point the company has received 100% of all the money. So the rest of the people who have applied for 2,000, 2,500, so their money will be refunded. Okay, now what happens? Let's see further. Okay, can you read, Shubhangini?
Yes, sir. Illustration of book building. The issuer, in consultation with the PRLMs, will finalize the issue price at or below such cutoff rupees 22. All bids at or above this issue price and cutoff bids are valid bids and are considered for allocation in respective category.
Okay. Now, the issuer is a company who is coming with an IPO in consultation with the book runner and lead managers, which are nothing but the merchant bankers. So they are in long called book runners and lead managers. Okay. So we even call them book runners and lead managers. So they are nothing but the merchant bankers or syndicate bankers who are helping the company to raise money. They will finalize the issue price at or below such cutoff price. So that means, most likely they will go for a price 22 because the company wants money at a higher price. So at 22, they are getting all their issue covered. So all bids or above this issue price and cutoff bids are valid bids. So all the, people who have raised them, made the bids at 22 or above, they become valid bids and are considered for allocation in respective category. Now you can be a qualified institutional buyer or any other investor. So there are various categories. So in earlier, even retail investors were part of this category. Okay, so if we just look at this, so 22 rupees become the issue price. Okay, so the rest of them will be ignored. So the people who have applied for 24, 23, they will get at 22 now. Okay, so they won't be charged 24, 23 because the issue price has been frozen to 22. So the first person who has applied for 500, he will get shares at 22 rupees. The second person who has applied for 1000 shares, he will also get at 22 rupees. And finally, the 1500 who has applied for 22, he will get at 22. So this 22 becomes the issue price. Okay. Okay. So this is called the book building process in short. Okay. And